In this video, we'll talk about temporary insurance. Now, temporary insurance is an extension of life insurance, okay? And life insurance, again, is just one solution to the risk of dying, which is a predictable risk that we can plan for. All right, so temporary insurance is there to cover temporary need. Now, when you hear the term temporary, what comes to mind, right? To me, what comes to mind is that temporary means there is an end, right? If someone is having a hard time and you tell them, this is going to be temporary, right? You're telling them there's an end to this, right? So, well, in temporary insurance, we're trying to cover a need that's there, but it's there for a temporary period of time. So, it starts at time A and it ends at time B, okay? Now, this time A to time B might be 1 year, okay? Might be 20 years, might be 10 years. It depends, right? But it's temporary. It's going to start, it's going to end, okay? Now, for this kind of a need, so this kind of a need, you can foresee ending, right? You can say it is going to start here, so the need is going to start here, right? And you can say that the need will end here, right? So that makes it temporary. It will start here, it will end here. Well, let's start with one insurance that will cover this. So let's go with a quick and a perfect example, okay? Okay, let's walk away from life insurance for a second. Okay, let's talk about car insurance. Let's call it car insurance. Okay, you go out there and you buy a used, okay, Honda Civic. Forgive me for my drawing scale. Okay, you buy a car, okay, and you want car insurance. Well, how does car insurance work? Well, car insurance, what they do is car insurance companies will cover, okay, your car, right? One way, two-way coverages. They will cover, okay, you with an amount, right? They'll give you insurance, okay, and this insurance you have to renew every year. Every year, right? And every year, if your record is good, then your premiums might go down and so on, but you have to renew every year. What does that mean? What that means is the insurance company is covering you from time A, okay? Let's say this is today. They're gonna start the coverage today, and it's going to expire, okay, at time B, which is 1 year from now, right? And now if you want coverage again, you have to buy another year's time, right, from time B to time C, and then you have to buy again from time C to time D, and so on. The key point here is your coverage is for 1 year every time. 1 year, 1 year, 1 year. So 1 year, 1 year, 1 year. So that makes it temporary insurance, right? You have to renew it because it expires. Now, just to go back again to life insurance, okay, we have an insurance that is just like this, okay, just like the car insurance I described here, and this is what that insurance is called. So it's called term insurance. Term. I'm just gonna call it life insurance for now. Okay. Well, just like the name suggests, this one, or this life insurance, has a start date and has an end date. In fact, this is what we call the start date. We call it effective date, okay, and we call it expiry date. Now, depending on the client's situation, he might want insurance for 1 year, he might want insurance for 2 years, and so on, but the coverage is from point A to point B. Okay, that's term life insurance. So let's look at one quick example here before we go ahead and talk about the types of term life insurances. Okay, so let's say John, okay, bought a term insurance, okay, for $500,000 for 10 years. Okay, so John says, I have a need. Let's say he has a mortgage. And the mortgage, he's going to take the mortgage today. He's going to sign the paperwork today. today he's going to sign the mortgage. He's going to start, right? And let's make it 20 years instead of 10. And the bank is giving him a loan, the mortgage, for 20 years. Okay, so this is 20 years later. Okay, and the bank says if you pay the mortgage every single month, in 20 years your mortgage will be done. You have here an example of a temporary need. Now he is concerned about this and this only. Okay, and if that's the case, then this is the need, right? Now we're going to recommend. Well, now you as an agent, right, here is what you recommend. You tell them, well, look John, we know point A, we know point B, so you need coverage here. If you die in the middle, right, if you die in the middle, we have a problem because the mortgage is not finished, right? It's not paid up, it's not done yet, and you're done, you're dead. And so we will need to pay the mortgage. Now Mr. John, if you live for 20 years, no problem, but if you die in the middle here, there's a problem. And so we're going to recommend an insurance, and here's what we're going to recommend. We're going to recommend a 20-year insurance. Okay, so a 20-year insurance that will start today and end 20 years later, right? Regardless of the amount, we can talk about that later. But so he comes to you with a mortgage that has a start date and end date. You suggest an insurance that has a start date and an end date. Start date called effective date, and the expire date is, or the last date of the insurance is called the expire date. Now one quick fact here is when John gets the policy from the insurance company, right? Here's a policy, right? It's got the name, blah 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 blah, it's got the company name. These two information here, the effective date and the expiry date, they have to be on the face page, right? On the face page we have to have a start date, we have to have an expiry date. It has to be visible and on the face page. Okay, just a fact.